Assalamualaikum to Miss Aina. Today, our team will present about the marine insurance for assignment 1. Alright, this is my group member. The first one is Siti Nadra, the second one is me, Siti Hadarida, and the last one is Nurul Faizah. And we explain about the introduction. Okay, a letter of credit is a financial tool used in international trade to ensure that a seller gets paid for goods shipped to a buyer. Documentary collection is a process used in international trade where the seller banks as an intermediary to collect payment from the buyer in exchange for the shipping document. Consignment is a trade arrangement where the buyer consignor send goods to the buyer consignee without transferring ownership until the goods are sold. Alright, I will explain about the scenario 1, which is Global Empire Trade is exporting medical equipment to a buyer in South Korea. To secure the transaction, the buyer requests a letter of credit from their bank. The LC specified the payment will be made to Global Empire Trade upon presentation in the shipping document, including the bill of lading, commission involved, and certificate of origin. Alright, first one is the concept of the letter of credit for the scenario 1, which is a letter of credit (LC) is a financial instrument used by a bank on behalf of the buyer importer that guarantee payment to a seller importer provided that a term and condition specified to the LC are met. The LC outline the necessary document and stipulate the condition under which a payment will be made. It as a form of insurance of both parties. The seller receives a guarantee of payment if they are complete with the term, while the buyer is ensured that payment will only be made after agreed upon goods or receive the delivery. Alright, the second one is the purpose of LC in international trade for the scenario 1 lah. Okay, the first function is risk mitigation. This means it reduce the risk for both the buyer and the seller. For the seller, it ensure that they will receive payment if they comply with the LC term. For the buyer, it ensure that payment is only made if the seller present the required document that prove shipment of goods. The second one is security. It provides a secure method of payment by involving bank in the transaction, by adding a layer of credibility and security. The third one is trust building. It helps in building trust between international trading partners who may not be familiar with each other. The next is compliance. It ensures that all things of the trade agreement are met before payment is made. The last one is facilitation of financing. It can be used as a financial to obtain pre-shipment and post-shipment finance for seller. Okay, for the last one is I will explain about the role of insurance bank and advising bank in this transaction for the scenario 1. Okay, for the first one is insurance bank. The insurance bank is the bank that issue the letter of credit at the request of a buyer. This role includes insuring the LC at the buyer request. The insurance bank create the LC in favor on the seller. Next is guaranteeing payment. The insurance bank guarantee payment to the seller upon presentation of the specific document that comply with the term and the condition of the LC. The next is document examination. It scrutinizes the shipping document submitted by the seller to ensure that conform to the LC term before making the payment. The last one is risk management. It assesses the creditworthiness of the buyer and ensure the buyer has adequate fund or credit to cover the payment. Alright, the second one is advising bank. The advising bank is the bank in the seller country that advise the seller of the LC insured by the insurance bank. Its role include advising the LC is notify the seller that LC has been issued in their favor without assuming any payment obligation. Second one is document handling. It receive the shipping document from the seller and forward them to the answer bank. The third one is verification. It verify the authenticity of this LC and ensure that it's a genuine and conform to the international trade standard. Last one is facilitation of communication. It as an intermediary for communication between the seller and the insurance bank, facilitating the smooth processing of the LC. Okay, from scenario 1. A South Korea buyer asked their bank to issue the letter of credit, which is LC, for Global Empire Trade in Malaysia. The South Korea bank sent the LC to a Malaysia advising bank, which informed Global Empire Trade. After shipping the medical equipment, Global Empire Trade present the necessary document to the advising bank. We send them to the insurance bank to verification and payment. Next, I will pass to next presenter.
Assalamualaikum. Hi, I will explain about the scenario 2. So the question is about the remitting banks forward this document to the collecting bank in Brazil, which will only release them to the buyer upon payment. So the definition about documented collection is a transaction whereby an exporter entrusts the handling of commercial and financial documents to a bank, which forwards them to a bank in the importer country, releasing the documents to the importer only upon payments or acceptance bill of lading exchanges. So we have 4 steps of process, which mean number 1 is shipment, document submission, document forwarding, and payment acceptance. So the next one is about the definitions of each process. The shipment is telling about the exporter ships the goods to importer. Document submission is about the exporter submit the shipping documents. Document forwarding is about the remitting bank sends the document to a bank in the importer's countries. So last one, payment of acceptance means the collecting bank releases the document to the importer only against payment. So we have several differences between documentary collections DC and letter of credit LC. So the differences between DC and LC, we have several elements, which is nature, bankrolls, payment assurance, risk exposure, cost, complexity, document handling. So the nature for the DC is conditional release of documents and LC is conditional payment commitment. For the bankrolls, DC saying the facilitator of document who giving the rule, and letter of credit LC is guarantee of payment. So the third element, payment assurance, for DC is less secure, relies on the buyer's ability, and LC is more secure, relies in issuing banks commitment. So the risk exposure is more high for the DC and lower for the LC. So cost for DC is generally lower and LC is generally higher due to the bank guarantees and services. So for the complexity, the DC is less complex, lower formalities. LC is more complex because it's involved multiple stages and compliance checks. So last one, document handling. DC, they just only release upon payment or acceptance by importer. LC saying that scrutinized by banks for compliance before payment. So we have 5 risks for the documentation. So number 1 is payment risk. So the example was the buyer in Brazil may refuse to pay or accept the bill of exchange upon presentation of documents resulting in non-payment. Creditworthiness, the exporter relies on the financial stability and creditworthiness of the buyer. So number 2 is control over the goods, may be delay payment acceptance. If the buyer delays payment acceptance, the good may remain in the port, incurring demurrage and storage costs. Number 3 is political economic risk. Maybe Brazil political and economic environment could affect the buyer's ability to pay, including currency fluctuation and import restrictions. Number 4 is limited resources, where the collecting banks in Brazil has no obligation to guarantee payment. Its role is merely to present documents and collect payment. Number 5 is documentary discrepancies. Any discrepancies in the document might give the buyer a reason to reject documents, delaying the process of payment.
e-commerce where a reseller, which is retailer in Italy, known as the consignee, pays the supplier, which is Global Empire Trade Syndrome Berhad, as the consignor once their product, which is fashion apparel, is sold. The supplier, Global Empire Trade Syndrome Berhad, provides the reseller with products without exchanging money. The reseller then puts the products up for sale in their store. The supplier also maintains the ownerships of the products until they are sold. Once the products, fashion apparel, are sold, the reseller will pay the supplier for what was sold and returns anything that wasn't sold. Next slide, I will explain about the benefits of consignment to both parties in the transaction. For the first benefit is about the reduced inventory risk. When a retailer receives goods on consignment, they don't need to purchase the inventory upfront. Instead, they only pay for what they sell. This can minimize the financial risk associated with holding excess stock. Second benefit is about the lower upfront costs. Since consigned goods are not initially paid for, the retailer can allocate their capital to other business needs, such as marketing or store improvement. For the third benefit is about the access to diverse inventory. Consignment allows retailers to offer a wider variety of products without committing to large purchases. This can attract more customers and enhance the shopping experience. Fourth, market expansions. By using consignment, Global Empire Trade Syndrome Berhad can enter the new markets without the need for significant upfront investment. They can test the waters and gauge demand before fully committed. Next benefit is reduced inventory holding costs. Since the goods remains in Global Empire Trade's ownership until sold, they don't need to store them in their own warehouses. This can help them to reduce storage costs. Next, potential for higher sales. If the retailer successfully sells the consigned goods, the Global Empire Trade Syndrome Berhad will get the benefit from increased sales revenue. We move again to another slide, which is about the potential risks of using consignment as a payment method in international trade. First one is about the ownership uncertainty. Since the Global Empire Trade Syndrome Berhad retains ownerships of the goods until they are sold by the retailer, there is a risk of uncertainty. If the retailer faces financial difficulties or goes bankrupt, and consigned goods could be caught up in legal disputes or delays. Second is about the payment delays. The retailer pays the Global Empire Trade Syndrome Berhad from the proceeds of sales. However, payments delays can occur, affecting cash flow for the supplier. Lastly is about the market rates. Fluctuation in demands, currency exchange rates, and market conditions can impact the value of a consigned goods.
So what I can conclude about this bank documentary collection is common and efficient methods of payment in international trade that balance risk and costs. However, exporters must carefully assess the associated risks by understanding this dynamic and employing risk mitigation strategies. Global Empire Trade Syndrome Berhad can be better navigate international transactions and secure its financial interest. Alright, thank you. That's all from me.